we get to Michael Ingram, market strategist, who's joining in on the show. Mild positive on the DAX. Remember, it's all about trade deals right now, and clearly Europe is not on the list of trade deals we might see in the next 48 hours or so. India definitely is. So Michael, thank you so much for speaking with us here at NDTV Profit. And let's start really with that big factor which is being watched. A possible mini trade deal is what we're hearing between India and the United States. Would it be seen as a big boost after what we've heard about the Vietnam deal?
Well, I mean, we obviously have to see what the details are. The devil, as they say, is always in the details. I mean, it's significant in as much as that Vietnam is a significant offshoring country for China over the last decade or so. So that this also has implications for a possible US-China trade deal, which I think is probably going to remain the most intractable of the sort of bilateral negotiations which are taking place. That said, in terms of the actual market impact, well, the market's really looking at a sort of a glass half full situation anyway. You're seeing most stock markets at or close to all-time highs. In many markets, particularly the US, they've already assumed that earnings growth this year is going to slow significantly, maybe 5% on the S&P 500, but it is convinced we'll see a significant acceleration into 2026, maybe 15% growth. So the market's already discounting really a soft landing. We're also seeing this on the rates market because the rates markets are also discounting an acquiescent Fed. They're assuming a degree of policy error from the Fed after the last FOMC, and perhaps looking up to 3 quarter-point cuts on Fed funds rates by the end of the year. Now, whether or not any of this bears out, of course, is a big question. Yes, I've said that the stock market's looking buoyant, but you do still have, for instance, gold still trading at very elevated levels. You're still seeing a very, very weak dollar, which has implications for the global financial systems. And interestingly enough, even though you're seeing sort of retail enthusiasm for risk assets, you're also seeing a lot of insider selling as well. So some mixed pictures out there and relatively elevated valuations.
Michael, hi, this is Harsh here. So did I hear you say that you're finding gold elevated, and this is at a time when there's heightened uncertainty, and that uncertainty is likely to persist given the US administration and its stance, and also the fact that central banks are continuing to stack up on gold? So give us the thesis there.
Yeah, well, your observations are absolutely correct. I mean, you talk to reserve managers. Yes, there has been some leakage into non-dollar assets. We've seen that in terms of flows into the Eurozone, but fundamentals of the Eurozone aren't great either. I mean, if you look at the most recent PMIs, yes, they've been tracking up so far this year, but we've spent almost 3 years in below 50 on a European manufacturing PMIs, which is not great. So this is a rebalancing to some extent. But as I say, growth isn't great in much of the Eurozone. India, I'd have to say, remains a standout in terms of raw GDP growth at this point. But yeah, I mean, by default almost, because they can't go into treasuries, because we haven't seen this decline in interest rates that was being anticipated rather for the last 2 years. I mean, the rhetoric from Powell remains, yes, we're patient, but there's a lot of uncertainty out there. So it's meant that a lot of the reserve rebalancing has gone into gold, and that's what's helping to support the gold price above $3,000 a troy ounce. So yeah, it's a real dilemma for asset allocators at the moment. There does seem to be the equity market is painting a very different picture from the other assets, I would say. And at some point, this bifurcation is going to be resolved, and generally speaking, it's resolved in a relatively painful way. But one thing I think I'm fairly sure is that we are going to see a significant uptick in volatility as we make that particular journey.
Just on a completely separate note, Michael, because your perspective on this would be interesting. What's happening with the London Stock Exchange right now? Reports that AstraZeneca, one of the most valuable companies listed on the FTSE, might be looking to move its primary listing to the United States. and this will deepen a crisis there. For our viewers who are not familiar with what's going on, please add some perspective to this.
Yeah, well, this is part of a broader decline, I would say, of the UK as a listing venue. My personal feeling, but it is mirrored by a number of other commentators, is that the UK, both as a real economy and as a stock market, remains over-regulated. We still have an archaic taxation scheme called stamp duty on stock market purchases, though there are ways around that, dealing on swap, for instance. And I think the fundamentals of the UK economy are looking, frankly, quite shaky. I think the fiscal situation here is increasingly in focus. And I think if we didn't have this sort of dollar weakness actually helping non-dollar asset markets, particularly UK gilts, then we've had a much more difficult time of it at the moment. But yeah, we've got a budget coming up, I think probably in October this year, and I think that could well be a flashpoint for a broader sterling crisis. But in terms of the narrow, your question in sort of a narrow sense, it's quite simple. People who are listing in the UK feel they could get better valuations elsewhere, and bearing in mind what sort of valuations we're seeing in the US right now, I can understand how AstraZeneca is looking to shift its primary listing.